Investing in apartments can be lucrative. It can also be risky. Taking out a loan is often necessary, but it's crucial to understand your options. Let's break down common loan types: fixed rate, adjustable rate, ARM, and interest only. With a fixed rate mortgage, your interest rate stays the same. This means your monthly payments remain consistent. This predictability can be comforting. Imagine a 30-year fixed rate loan at 5%. Your monthly payments would be steady for 3 decades. Now let's consider ARMs. These loans start with a fixed rate for a set period. Then, the rate adjusts periodically based on market conditions. For example, a 5/1 ARM might offer an initial rate of 3.5% for 5 years. After that, the rate could fluctuate annually. Lastly, we have interest-only loans. Here, you only pay the interest for an initial period. This can result in lower monthly payments. However, you'll eventually have to repay the principal. Imagine a 4% interest-only loan for the first 10 years. While initially attractive, you'll face higher payments when the interest-only period ends. Understanding loan terms is important, but you also need to crunch the numbers. This means calculating your monthly payments. It also means understanding key financial ratios. We can use the amortization formula to calculate monthly mortgage payments. This formula considers the loan amount, interest rate, and loan term. Let's take our 5% fixed-rate loan example. On a $300,000 loan over 30 years, your monthly principal and interest payment would be $1,610.46. Lenders use 2 critical ratios: the debt service coverage ratio, DSCR, and the loan-to-value ratio, LTV. DSCR measures your property's ability to cover debt payments. A DSCR above 1.25 is generally considered healthy. LTV, on the other hand, represents the loan amount compared to the property's value. Lower LTVs, typically below 75%, are less risky. Your loan choice directly impacts your cash flow. It also affects your potential equity returns. Let's explore how. Fixed-rate mortgages provide predictable payments. This makes budgeting easier. However, they may lead to higher initial payments compared to ARMs or interest-only loans. Lower payments with an ARM can free up cash flow, but be cautious of potential rate increases. Interest-only loans offer the lowest initial payments. This can boost cash flow in the short term. However, you'll face a balloon payment when the interest-only period ends. Equity is the property's value minus outstanding debt. Your loan type influences how quickly you build equity. Fixed-rate mortgages gradually build equity through consistent principal payments. ARMs can lead to faster equity growth if interest rates remain low, but they also pose a risk if rates rise. Interest-only loans delay equity buildup. This is because you're not paying down the principal initially. Navigating loan scenarios can feel complex. That's why it's crucial to use financial tools. It's equally important to engage with knowledgeable lenders. Financial calculators and spreadsheets are invaluable. They help you compare loan scenarios side by side. They also allow you to perform sensitivity analyses. This involves adjusting interest rates, DSCR, and other factors. This shows how your financials hold up under different market conditions. Don't underestimate the power of building relationships with lenders. Experienced lenders can guide you through available loan products. They can also help you secure competitive interest rates and terms. They can even provide insights tailored to your investment strategy. Remember, knowledge is power. By understanding loan options, performing due diligence, and seeking expert advice, you can make informed decisions. This will set you on the path to successful apartment investing.